Venkatesh Balasubramaniam joining in on the show right now to talk about what he's making of the market. Venkatesh, hi. Great to have you on ET Now. Venkatesh, the worries behind us. What's the fresh call in the market now?
Firstly, thank you for having me on your show. Now, on the market, I think if you went back 1 week, the biggest thing that everybody was discussing was when will the war end. Now, given that we have some visibility that the war is perhaps ending, a treaty is going to be signed tomorrow. So, and Hormuz will be opened. It's quite a big positive. But the focus goes back now on earnings. This is where the bigger worry is right now. What we are having discussion with most institutional investors is on the current year numbers. Given the backdrop that we've had 2 successive years where consensus started earnings had expectations of almost 15% kind of growth. In FY25, I think what came through was maybe between 3 to 4% kind of EPS growth on the Nifty. For FY26, the growth has been somewhere between 5 to 7%. Once again, consensus expectations for the current year is very aggressive. The expectation is almost 16 to 17% growth. But we believe there is a significant risk of a downside there. Given that you had, even though oil prices have come down from their peaks, it is much higher than where it was before the conflict started. Before the conflict started, crude oil prices were at around 65. Now you are closer to maybe 80s. You are in the 80s. The 7.5 rupees kind of fuel price hike which has happened in India, it doesn't still make up for the losses that the OMCs are making. So we continue to be worried about inflation in the current year at the margin, because inflation, we believe, this year should be closer to the 5% kind of levels. Now, if that inflation is there, obviously there will be earnings cuts which will happen. Earnings estimates still look very aggressive, and that is where the bigger worry is.
Okay. And Venkatesh, you have a great lens of the macro along with earnings as well, right? I mean, you track it fairly closely. So give us a sense. How's it looking at this point of time, FY27 versus consensus? Are we going to have another year of decent growth, or is growth at risk? And how does EPS estimate stack up both on the large cap end as well as mid and small cap?
See, you start the year with expectation of 17%. Just like last year, it is on the aggressive side. I believe what is a more realistic kind of a number is closer to high single digits, maybe closer to 8 to 9%. So if the market seems cheap to you at this point in time, relatively cheap, it is not as cheap, because we believe as we move a couple of quarters, some of these numbers will get cut. Now, coming to the distinction between large cap, mid caps and small caps, clearly your mid cap is the category which is the most expensive. Whichever way you look at it, whether you look at it on a PE multiple basis, you look at it a PEG multiple basis, where we are finding value is obviously more on the large cap side. And surprisingly, we see very decent value on the small cap side also. Mid cap clearly looks super expensive to us.
Very interesting that you say that right now, because the mid-cap end of the market is where you're seeing consistent gains. So again, what specific pockets within mid-caps are looking toppish to you or frothy?
I mean, you look at anything. It is not just about any particular sector. You have a look at, let's take the example of, let's say, IT, for example. Now, IT, we are underweight on the sector. If you look at the large cap stock, they all look very cheap to us. Whereas you go more towards the mid cap side, maybe the Persistent or the Coforge, these kind of stocks, they are clearly very, very expensive. So a similar thing you can see even maybe in the auto side. You see some of the large caps, like for example, look at Tata Motors PV, look at Hero Honda, they look very cheap. Whereas you go more towards the mid cap side, it looks very, very expensive. So it is okay when that sector is doing very well. Let's say you believe a particular sector is going to outperform. So in that sector, if the mid caps are expensive, mid caps tend to do well. But if you are holding mid caps in a sector which you are expecting that it will underperform the market, it could actually cut the other way around. So that is something that you need to worry about, especially if you are expecting that sector to underperform. For example, we have a decent size underweight on IT. We have a decent size underweight on banks. So here we would ideally be avoiding mid caps.
You have an underweight on banks. Explain that to us, Venkatesh.
Okay. Last year, banks did 15% loan growth. The EPS growth in banks was 7%. Very, very disappointing. Last year, again, what delivered? PSU banks delivered. Private sector banks did not deliver. Private sector bank numbers were weak. This year, as you go into this year, again, we are expecting 15% loan growth. But overall, for the sector, we are expecting only around 7% kind of EPS growth. The PSU banks will actually deliver negative growth this year in terms of EPS. This year, what is happening is the fee income pool has become lesser. Most of the banks are actually lending more to corporates. So the additional fee income part is missing. Profitability is much lower this year, again, similar to last year. So that is a cause of worry. In PSU banks, you will not have perhaps have treasury gains, and you will also not have write backs. So your PSU bank numbers will also be on the weaker side. Hence, we have almost like a 408 bips underweight on banks.
Okay. And Venkatesh, in terms of sector rotation, that's also at play. Certain sectors, certain stocks, especially in the mid-cap basket, are doing extremely well for itself. You're good with this, with regard to what's likely to come back into vogue. What's looking good?
See, specifically, I am like, there is a relief rally which is happening. Okay. You were holding a certain set of mid caps, which were supposed to underperform because you were expecting the war to continue. You were expecting inflation to be high. You were expecting crude oil prices to be high. And you assumed that these sectors, the numbers will be on the weaker side and will get cut. Now the whole thing has reversed, right? So you are seeing a relief rally in some of these mid-cap stocks. But one needs to remember that at least the first half of the year is going to get washed out. So let me take the example of, let's say, maybe a mid cap on the auto side. Auto numbers are still weak, are still very strong. But we are expecting that the weakness in mid cap auto you will start seeing through in the next couple of quarters. So I would be very cautious. I would not be chasing this rally in mid caps at this point in time. We believe it will fizzle out in the next couple of weeks.
Very interesting that you say that, though, Venkatesh. And what about autos? Is a delayed monsoon also a looming concern?
A delayed monsoon is a problem. Raw material prices are going up. Some of them have taken price hikes. If those price hikes happen, we believe that the demand could actually peter out over the second part of the year. Please remember, GST cuts happened in the month of September. So post-September, till let's say before September, you will see very good numbers in auto. But from September, the base becomes extremely high. And that is where you will start seeing disappointments when it comes to auto number in the second half. We are incidentally underweight on auto by almost 226 basis points.
Oh, okay. So how do you play consumer then? How do you play consumption, Venkatesh, as a theme?
So we are playing consumption through normal FMCG. We are playing it through consumer durables. So this is how we are going about playing consumer. We are overweight on consumer. We have stocks like Marico, we have Havells, we have Crompton consumer. So these are some of the stocks. We also have Titan in our consumer portfolio. So these are some of the ways which we are playing consumption. We are not doing it through the discretionary basket, which we were doing maybe some time back. 6 months back, we were doing that. But now we have gone more towards FMCG and consumer durables. Interestingly for you, both FMCG and consumer durable valuations are extremely cheap. Consumer durables, whether you look at it in 5-year PE multiples, 10-year PE, it is trading one standard deviation below mean. Interestingly, on Marico, for example, it will be one of the FMCG stocks where you're going to see very decent double-digit revenue growth, and you're still going to see margin expansion in Marico. So this is one of the stocks which we have in our model portfolio.
With regard to consumer durables, Venkatesh, we were speaking with an analyst earlier today. He was saying that while secondary sales look good, primary sales is where the problem continues to lie. What are you spotting on ground that's keeping you bullish? Do you believe Q1 FY27, which is crucially the only quarter for the year for them to really perform, do you believe that it's going to be a standout? And if so, what are your top picks?
Like we said, I think what your consumer durable analyst would be talking about AC sales primarily. That is where they are quoting these data points, which, the dichotomy between primary and secondary sales. Interestingly, both Voltas and Blue Star, which are the primary stocks which they talk about, or maybe PG Electroplast, which is making the ACs, are not part of our model portfolio. What we have is somebody like Havells and Crompton Consumer. We look at very specific bottom-up reasons why we include a particular stock in our model portfolio. In the case of Havells, for example, stock is super cheap. It is not as expensive as some of the AC names. And secondly, Havells is having a very big improvement in its cables and wires division. So we are going to see, because they are significantly ramped up capacity on the cables and wires division, which they had not done for a number of years in the past, which should actually hold them in very good stead, and the numbers should be extremely strong over the next 2 to 3 quarters.
Right. Okay, great to then have you on the show, Venkatesh. Thanks for joining in with your views.
Thank you.